Okay, so let's continue. So basically, as you understood from the previous slides, you see that growth is only good when you're growing in good investments. And when your return on equity is higher than your minimum required rate of return, then those investments are positive NPV projects. NPV is net present value, so the projects will bring you more cash than cash outflow. In that case, shareholder value will be increased. And when I say shareholder values, I'm talking about stock price as well. Stock price will increase if you have good investments. In the opposite case, if your return on equity is less than R, then the CEO is investing in bad projects, so shareholder value will decrease. And in this case, the CEO is basically is using the shareholders' cash in a bad way. So shareholders are giving you the money for 12% return, as we talk about in our example. This is the minimum return they require from you. They don't do the investment themselves. They give the money to you, and they are expecting you to do good projects. But if you go and invest in a 10% return project, then then shareholders would be better off if they use the money themselves instead of investing in your company. Okay, so overall, you can see the price comes from two places. It comes from one, the present value. It comes from the value of all the assets in place, which is the no growth price, which is dividend over R. And in no growth case, remember, dividend is equal to earnings per share anyway, because all the earnings are paid out as dividend payments. Bunun neden geldiğini anladınız mı? Burası no growth zamanı. No growth'ta bütün kazanç temettü olarak dağıtılıyor. So in the no growth case, dividend is equal to earnings per share, only in the no growth case. So the value of the stock comes from two places. One, the value of assets in place, and the second one is present value of growth opportunities. And in our previous example, remember, $75 was the price with growth, $41 was the price without growth, so the difference was present value of growth opportunities. And it's only positive when return on equity is higher than R. Let's look at this simple example before we summarize, move to market efficiency. Suppose a stock is selling today for $55 a share and there are 10 million shares outstanding. If earnings are projected to be 20 million, how much are investors assigning to growth per share? So what is earnings per share in this example? Earnings per share. Earnings per share. Earnings per share. What are earnings? What is the number for earnings? What is earnings? 20 million? 2 million? What numbers of shares outstanding? What are the numbers of shares outstanding? 10 million. So what is earnings per share? 2. Exactly. The discount rate is 10%. So the stock price is $55 today. Earnings per share is $2. Discount rate is 10. So from this equation, you can calculate the present value of growth opportunities. So in this case, this is 20, this is 55. So present value of growth opportunities should be equal to 35. What is the takeaway? The value of the stock comes from two things: assets in place and growth opportunities. And growth opportunities bring positive value only when return on equity is higher than your minimum required rate of return. Any questions? Thank you. Any questions? Okay. Now let me give you some investment advice. No, I'm not going to do that. But finding mispriced stocks. What does it mean, mispriced? Can a stock be mispriced? Yes. Yes. So can a stock be overvalued? Can it be undervalued? When would you buy it? Buy a stock when it's overvalued or undervalued? You buy it when it's undervalued, and you sell it when it is? Someone just told me that a good investor is the one who knows when to sell. It has nothing to do when to buy. He says you should know when to sell your investment. So you sell when you think it is overvalued. Do you think it's an easy task to find mispriced stocks? Can you find mispriced stocks easily? No, it's probably not that easy, right? So let's look at those. Do you remember mutual funds? What were mutual funds? Mutual funds, basically, they create a basket for you. They put lots of stocks and different investments in it, stocks, bonds, whatever. And you pay a fee to the mutual fund manager to do the investment for you. So they do the diversification for you. So when you pick a couple of stocks, they pick 20, 30 for you immediately. So mutual fund managers make lots of money, okay? And they are very smart people. They have PhDs in top schools in math, physics, whatever. In hedge fund managers, they're even crazier. Very, very smart people. So if there's someone who can find mispriced stocks, then they should be the one, right? They should, because this is their job. So Carhart, an academic person, he looked at 1,500 US mutual funds, and they compared the mutual fund returns with the market index. What is market index? S&P 500 basket. So instead of buying individual stocks, you can go with S&P 500 index, which is way less risky because it's a very diversified. It's supposed to be fully diversified portfolio, very small amount of risk. So he compared the returns of mutual funds with the stock index, market index. And this is from 1962 to 1997. As you can see, which one? Okay, blue ones are the mutual funds, red one is the market. In some years, mutual funds did well. In some years, stock market did well. So overall, he said, mutual fund managers cannot consistently beat the markets. They cannot bring higher return compared to the market. So they're not that good finding mispriced stocks. You can just buy S&P 500 index, and in some years you're making more money anyway. Why are you giving a fee to the mutual fund manager to pick the stocks for you? Then I have another one. This is from Malkiel, A Random Walk Down Wall Street, interesting book. So he looked at mutual fund performance relative to the market, again, from 1970s to 2001. When you're looking at an investment return, you should always compare it with something, like inflation or with risk-free bonds, whatever. If I'm telling you, oh, I brought you 10% the last year, you should say, okay, but what was the inflation? What did the market brought? What was the risk-free rate? So you do the comparative analysis of how well your investment did. And we are generally comparing returns with the market. So as you can see here, I have lots of mutual funds, which brought me, like 30 mutual funds, made me lose 4% in my investment. So there are lots of other ones here, all made me lose money compared to the market index. There are a couple, they brought me lots of money, yes, one or two, which brought me more than 3% on top of the market index. But overall, as you can see, mutual funds generally brought what market index brought to you. So this is what market efficiency people are saying. They say stocks can be mispriced, but you cannot consistently beat the market. Okay, so you cannot have a strategy that will work forever. This is what market efficiency is about. And you heard about French, I think. He got the Nobel Prize last year, Ken French. Former French are huge advocates of market efficiency. So they say markets correct itself basically. So in this aspect, like on Twitter, if you're following people, there are lots of technical analysts, for instance. Okay, what they do is they look at patterns in the historical prices, and they they also call wiggle watchers. Wiggle watchers, because they look at all the patterns in the stock price, and they try to guess what's going to happen in the future. Like literally wiggle watchers. So they say historical prices has information about future prices in it. So we can guess future prices based on historical prices. Now let me show you this. This is return on day t plus 1 compared to return on day t. Let's suppose this is the return of a stock on Monday. This is return on the stock on Tuesday. So we're trying to see whether there are any patterns here, whether Tuesday prices, Tuesday returns are based on Monday returns. Do you see any predictability here at all? Any pattern? No, we don't have anything. So if this is the case, do you think technical analysts can find mispriced stocks all the time? Sometimes. They can sometimes find it, of course, otherwise they wouldn't be able to make any money at all. Finding mispriced stocks are okay. It is in line with market efficiency. Market efficiency only says you cannot do it all the time. They say maybe you got lucky. Maybe there was some mispricing in the market for some reason, but once we know it, it should be corrected. Let's continue. Random walk theory, we don't have internet. Normally here, I generally show a video of a drunk guy walking to show you random walk theory. But according to random walk theory, they say security prices change randomly with no predictable trends or patterns. So it's exactly like a drunk guy walking, like when there's no lights on, let's say, okay, no predictability whatsoever. They go like this, like this, okay, you cannot guess what the next move is, okay? And because of that, looking at a price, historical price, shouldn't give you any information of what's going to happen in the future. Of course, when the stock price closed at 100, you know that the next day it's going to start with 100. You know the starting point, but you don't know whether it's going to be 102 or 100 or 98. Okay, so there's like random walk theory. I will talk about this later. Okay. So let's look at this. This is taken from its time previously. Timing is not important. One is the return for S&P 500 index. The other one is random draw. So it's just head and tail. You do head and tail. If head comes, it's 10% return. If it is tail, it's minus 10%. So can you guess which one is S&P 500, which one is random draw? No. So according to random walk theory, this is indeed the case. Everything is random. All the prices are random, let's say. So there is also fundamental analysts. These guys are one step ahead of the technical analysts. What they do is they look at all kinds of fundamental data, not just historical prices, but they look at all the accounting data. They read the footnotes. They look at future investment opportunities, everything, and they try to find mispriced stocks accordingly. I remember when I took this class, I took the MBA class from Matt Billett, my advisor who is in Indiana now. I remember him telling this, giving this example. He said, there are lots of people who work on Wall Street. Top of the top guys. It's the cherry on the top kind of guys. Okay, they are really smart. They are spending 19 hours a day on the computer trying to find mispriced stocks all the time. And he says, do you know like how many a year, how many mispriced stocks they can find in a year? If they're lucky one. So he said, if this is just Wall Street, there are lots of other business districts as well, like people work in London, Japan, whatever. They're all trying to find mispriced stocks. So he says, if you think that if we're in a market where there are lots of talented analysts going after all the information, using all the sexy mathematical techniques and everything, can you think that they can really find mispriced stocks? And the answer was no. And he gave a couple of examples from his friends, and they are working in that area. And they said if they're lucky, they can find only one mispriced stock a year. So it's not very easy. For instance, you see all those people. There were a couple in U.S. I'm sure we have investment gurus in Turkey as well. They say, okay, you should do this, you should do that, and they write books, and this book will bring you like $1 million at least. Do you buy it? I don't buy it. If I found something like this, I wouldn't share it with anyone, right? Because if everybody plays on the same strategy, then the returns will go away, right? This is exactly what market efficiency people say. Even if you find some kind of a strategy, you can make money on it, but once people know about it, it's gone. The market corrects itself, according to market efficiency. Let's look at this example, for instance. Okay. Okay. So suppose that this was the return for a market index. Sorry. This is the market index for up till this month. And suppose that there was some kind of new information related to a company. Of course, since there's new information, we should see a stock price reaction. And you see the stock price reaction immediately occurring at the announcement. But if markets are efficient, those cycles will disappear immediately once everybody knows about it. When I started giving this lecture, like I think 5-6 years ago, probably changed, but I read somewhere, when there is a new information about a company, do you think how long it takes for the stock price to react to the announcement? Not react and then settle down, let's say. So there's an announcement, a company is making an announcement. How long does it take for the stock to get this new announcement and then settle? It was less than 5 minutes, like 5-6 years ago. Now it is even sooner than that, I'm sure. Now information is like, it is crazily traveling. So you get the new information, it is reflected in the stock price. Immediately there would be a huge jump in the stock price, which is okay, because there's new information, stocks should react to it. But then everything should settle after a while. Its effects should just disappear. So this is what market efficiency is saying. So going back to our terminologies, an efficient market is a market in which prices reflect all available information. So when you look at the price, it has information about past, it has information about the accounting data, it has information about the future prospects of the company, everything. So according to market efficiency, stock prices reflect the true values of companies. And there are 3 different forms of efficiency. One is weak form efficiency. It says market prices reflect all historical information. So do you think technical analysis would work if it is the case? If prices already reflect all historical information, would you find mispriced stocks looking at historical prices? No, it is the historical prices are already in the stock price. There's nothing. There's no new information in the past. So technical analyst's job is garbage if the market is weak form efficient. There is semi-strong form efficiency. We are making it a little bit tighter. Let's say it says market prices reflect all publicly available information. So all the accounting information, everything, it is embedded in the stock price. So fundamental analyst's job is garbage, because the stock price already reflects all those information they're going after. The last one is strong form efficiency. This is the strictest form. it says market prices reflects all information, both public and private. Bu çok sert. Bu diyor ki whatever CEO knows, we know. All it is reflected in the stock price. There is no insider information. So these are 3 steps of market efficiency. And it is like this. If a market is strong form efficient, of course it should be weak form efficient as well. Because this says prices reflects all public and private information. This says prices reflects all public information. This says prices reflect all historical information. So if a market is strong form efficient, then it is automatically weak form efficient as well. So when we think about think about US market, for instance, we can say it is almost strong form efficient because of all the analysts and everybody and all the transparency going on there. But let's talk about it in a second. Let's go over this. Weak form efficiency, let's remember, it says prices contain all historical information. Stock prices are not predictable. Returns follow a random walk, okay? Remember that messy graph with all the dots, okay? This is what a weak form efficiency says. And according to, if the markets are weak form market efficient, then patterns in prices shouldn't exist. Prices should follow a random walk. Technical trading strategies shouldn't find you mispriced stocks all the time. In the exam, when we ask essay questions, this is something we ask. So suppose that your friend came to you and he said, "Oh, I found a stock and I'm gonna make I made tons of money on that stock." What would you say if you believe that markets are efficient? What is your explanation to him? Can he find mispriced stocks if the markets are efficient? Yes, he can, but you can say, you were just lucky. You know, it wasn't a pattern. You were just lucky. It says patterns do not exist. So if he comes to you and says, you know, every Tuesday this stock's price increases, every Tuesday. You say, okay, I think you were just lucky. Okay, maybe you were lucky 3 weeks in a row, but it was just luck. It's gonna disappear. And actually, it's interesting. Like there was like Monday effect. Stock prices were high on Mondays, and then there was like January effect. Again, stock prices were increasing on January, and these were like known facts. Like there were papers written about it. Once papers were written about it, they disappear. Once people know about it, people play on it, they disappeared, all of them. And we have 3 puzzles we cannot solve, but the remainings are once it made publicly available, then people started investing on it, and then more people invested on the same strategy, they disappeared. Okay, so this was weak form market efficiency. The other one is semi-strong form efficiency. It says prices contain all publicly available information, current and past. This is important, everything publicly available, no stone left unturned. And according to this is important. You may have something like this. What this is for a company, and they are announcing a merger. They're announcing that they're going to be taken over by another company. And we know that for the target companies that will be taken over, at the announcement, the stock prices increases. It's good for target companies to be taken over. So this is the days relative to announcement date, and this is the cumulative abnormal return. Okay. So what happens here? This was an exam question, actually. I asked this. I put this in the exam and asked a couple of things about it. So here we have the announcements. And as expected at the announcement, stock prices increase. So if you look at this part of the graph, look at this part. Is this consistent with semi-strong form efficiency? Remember, semi-strong form efficiency says prices reflects all public, all public information, past and current. Is it consistent with semi-strong form efficiency? So is this jump okay for market efficiency? It's okay. When there's new information, of course, stock price should react to it. So this jump is okay. Semi-strong form efficiency says, yes, prices should adjust immediately when new information comes, but then it should settle. So as you can see, there's no more increase after that. Okay, so you see the valuation increase, shareholders think, at the jump. Here, we don't have anything. So let's go one step further. Okay. Okay, so we said price adjust immediately to new public information. Fundamental trading strategies should not work if the market is semi-strong form efficient. Why? Because fundamental analysts look at public information, and according to semi-strong form efficiency, prices reflect all publicly available information anyway, so there's nothing left anyway. So it should not work. In the strong form efficiency, it says prices reflect all information, all public information, all private information, including what CEOs know. And it says prices would adjust immediately to whatever happens in the economy, in the world, in the firm, in the industry, whatever. And it could be impossible for any investor, even the CEO, should not make consistently good returns. Bu biraz iddialı. And US actually is trying to make markets as efficient as possible. And they have all those insider trading laws as well. They're trying to ban CEOs to make money over their private information. Of course, CEOs know more than we do, right? They're in the business. So, and now actually when CEO is going to buy or sell his stocks, they have to make it publicly available. I think it says on Economist, like if you look at the last page in US, you see all the insider trading information. So they are making whatever information is available, publicly available as well, so that markets will be efficient. So let's go back to this example. So here at the announcement, I understand there's a big jump, consistent with semi-strong form efficiency. What is this?
Some announcement, but that means some people know that before the announcement, this is a private information, therefore it's the area of the strong.
It's basically information leakage, right? Probably someone inside the firms, they leaked information. Yes?
Maybe they are just taking risks because the announcement date is already known before that.
Oh, but no. It is all, no, this is almost like this is the announcement of a possible takeover, like before all the meetings were publicly made available, let's say. So this should be the time when companies, the shareholders know about the possible takeover. So here, probably there was information leakage, right? So, or maybe expectations, or somebody was expecting it. So you see, when there is insider information leaking in public, you see stock price reflecting as well. So it's still consistent with market efficiency, actually. So these are the things that are about how well markets are efficient. But now I'm going to give you a couple of examples why markets are not that efficient. And these are called basically market anomalies. So market anomalies are the patterns that should not exist if markets are efficient. It's an anomaly. We have earnings announcement puzzle. This is funny. We cannot solve this and it doesn't disappear for 20 years or so. It doesn't go away for some reason. So according to this, when there's earnings announcement, companies announce their earnings. And when there's positive earnings announcements, you would expect stock price to increase, right? When there's negative earnings announcements, stock price should decrease. This is really what's happening in real world. But the problem is, remember we said after the announcement, stock prices should settle, right? But for some reason, after positive earnings announcement, prices go up and then continues to go up. For the bad announcements, prices go down and then continues to go down. which shouldn't happen in an efficient market. So we cannot solve it still. It exists. The other one is new issue puzzle. Stock issues, IPOs. At the IPOs, people rush into buying the stock. Stock price increased a lot. But then in the long run, IPOs always make you lose money. There's a huge jump, mispriced basically. And in the long run, if you keep the stock, then you're going to lose money. This is the new issue puzzle. It doesn't disappear. It's puzzle because people are overreacting to the IPO issues. So it means they are paying more money than they're supposed to at the issuance, let's say. They rush into buying it.
So isn't that the reason that it falls afterwards?
Yes, but I mean, I understand what you're saying, but there are lots of going on. I'm explaining it in a very simple term. But let me find a couple of little documents about it, and I can send it to all of you. But I think these are interesting topics for your free time. The last one is bubbles. If markets were efficient, we shouldn't have bubbles. But we saw it in the tulip bubble. Bizim sorumlu olduğumuz, Osmanlıların sorumlu olduğu bir lale devrinde bir lale tohumu inanılmaz bir fiyata satılıyordu. Şu anda hatırlamıyorum. İnanılmaz bir fiyata. Onu da araştırayım. Unuttum. İnanılmaz bir bubble olmuş. Ama bu da bir bubble. Or you know the real estate bubble that burst in 2008. You know the dot-com bubble in 2001 in US. So these shouldn't happen in an efficient market. And then we have, I think this is the last one. These are very interesting topics actually. In behavioral finance people, they say, look, whenever we talk about markets and people, we always believe that people are rational. And everything can be mathematically proven. But it's not the case. People are not rational. And two important areas here are lots of behavioral people are explaining those bubbles actually, or anomalies. But we cannot explain it with our good math, what's it called, evidence, let's say. One is attitudes towards risk. So it says people generally dislike incurring losses. We don't like losses. Yet they are more apt to take bigger risk if they're experiencing a period of substantial gains. Kumar oynayanları düşünün. Kumar oyunu kazanıyorsunuz. O anda riski, ya probability hala aynı. Masadaki probability aynı. Ama oynamaya devam ediyorsunuz. Neden? Kafanızdaki risk algısı değişti. Kazandınız ya biraz. So this is like gambling. Like when you make money, you say, okay, I'm on a good roll. Everything is great. Even if the probability of the roulette table is the same, you are thinking that the probability of losing is diminishing. Mathematically, it's not, but in your mind, it is. And in the dot-com boom, this is exactly what happened. Investors experienced huge returns on the technology firms, and they just stopped worrying about risk. So they made lots of investment with high risk, and it burst at some point. The other one is beliefs about probabilities. Individuals commonly look back to what has happened in recent periods and assume this is a representative of future outcomes, like in the gamble example. Many investors believe that they are better than average investors. When you make money, you're like, yes, I know what I'm doing. And then when you make money, you go to your father, your friends, you say, okay, I know a strategy. We can make tons of money from it. This is overconfidence, and this is not rational, actually. So these are all things that tells us market efficiency can fail sometimes, and also we are people. We're not that rational. We have 10 minutes left. Let's try to look at a couple of examples if we can. In late 2007, the share price of Pepsi stock was about $72. Okay? So 2007 price was $72. The company earned about 340 a share. 5. $3.40 a share and paid out about 40% of earnings as dividends. O da çok kötü ya. Ha, iyi değilmiş, tamam. So, 5, earnings per share is $3.40. 40% of it is paid out as dividends. Investors in 2007 were optimistic about the prospects for Pepsi and were forecasting that earnings would grow over the next 5 years by 11.5% a year. And then decrease to 6%. So 11.5% increase in growth for 5 years, and it's going to decrease to 6%. Assuming that the investors require 8% 5 return from Pepsi, calculate the intrinsic value of the stock. Stock price is given to you. The question asks you the intrinsic value. So what am I going to do when I have a question like this? So what am I going to do is I'm interested in calculating the intrinsic value, which is the present value of all the future payments. So what am I going to do is I'm going to calculate I'm going to calculate the dividend payments first. Important thing in those stocks, when you have a change in strategy, you go with earnings per share. Bakın bu önemli. Sınavda hep bunu, böyle bir şey sorduğunuzda hep hata yapıyorsunuz. Dividendları grow ederek gitmeyin. Earnings per share'lere gideceksiniz. So when we have a strategy change question like this, growth changes in the middle, or payout policy changes in the middle, go with the earnings per share. Then calculate dividends. So what we are going to have is we're going to have something like this. So earnings per share for the next 6 years. We're going to calculate earnings per share, and then we're going to calculate dividends. Okay? So my earnings per share at time 0 was $3.40. And it's supposed to grow by 11.5%, right? So what am I going to do? It's going to be $3.40 earnings per share at time 0 times 1.115. So I grow earnings per share by the growth rate, which will be equal to 379. I'm going to do the same thing next year. 379 times 1.115. So it's going to be equal to 423. So for the 5 years, this is what I'm going to do, okay? I'm going to multiply the previous year's earnings per share by 1 plus G. We were doing this with dividends before. Now I'm just doing it with earnings per share. It's the same thing. Growth is growth in equity anyway. So let's do the same thing. I'm not going to write it, but it's going to be the same thing. So these are your earnings per share. After the 5th year, you have the growth of 6%. So here you're going to have 5.86 times 106. So in this case, I don't have a calculator. Could you tell me the number? Okay. So then it says, we need dividends. From earnings, how am I going to calculate dividends? Dividends are 40% of earnings per share. So it's going to be earnings per share times 40%. So for each year, this is what I'm going to do. It's going to be 379 times 40%. So it's going to be 152. Then it's going to be 169. I'm doing the same thing every year, okay? I'm just multiplying it with 40% every year. 40% of earnings per share. So these are your dividend payments. Now, how am I going to calculate the stock price? Or intrinsic value, sorry. What is the intrinsic value? It is similar to the first question we solved today, non-constant growth question. What am I going to do now? So from here to infinity, I have constant growth, right? So here I can use constant growth formula. But when I do this, it's going to give me price at 5. So what is D6? 248. What is R? 8.5%. What is G? 6%. So from here, I can calculate the price at expected price, which is going to be 99.2. So when I do this, this price, this expected price, gives me the value of all the future dividend payments from time 5 to infinity. Now what am I going to do? I'm going to bring all those dividend payments to time 0 by the discount rate. And of course, I'm going to bring this price to time 0. This way, I'm covering all the dividend payments. Right? It is 6. The growth rate, R minus G. Okay. So how are you going to discount all those? With 1 plus R. So it's going to be 152 over 1085 to the power 1. This is going to be 169 over 1085 to the power 2, blah, blah, blah, blah. This is at time 5, so you're going to discount it by 1.085 to the power 5, of course. So if you add them up, then the price you calculate will be equal to 73.35. This is the intrinsic value. So this was the exam question, part A. You calculated the intrinsic value. And then I'm saying the price was $72 at that time, stock price. Would you buy the stock or not? Would you buy the stock? Would you buy the stock? So the intrinsic value is is based on your expectations about the price, and you believe that the value of the stock is $73. In the market, its price is $72. Then you would buy it, right? Then it's a good buy for you. To you, this is an undervalued security. Yes.
We are discounting the 99.22 for 5 times.
Yes. Let me write it as well. So this is going to be 99.2, 1085 to the power 5. Okay, so on Friday, you're going to have a quiz on bonds and stocks together. Bilmiyorum. Uzun olacak. Yani bir quizin 2 katı uzunluğunda olacak. Okay, then I will see you Friday.